everybody, so welcome to another session. Now in this session we are going to catch up on the idea of the dividend growth model, and we would see that within the syllabus this is used for more than just dividends. We use it to find terminal value of cash flows as well. So let's find out how all this is done. Welcome, my name again is Irwin, and I hope that you learn much from this session. So let's move straight away to the dividend growth model here. Now, in the Singapore Chartered Accountant program, this is assumed knowledge. Let's look at what it is. Basically, it is the underlying concept of how you can value a share based on its cash flows. And what are the cash flows of a share? The most obvious one, if you are a shareholder, is that you would receive dividends year after year. Therefore, this concept argues that you can just value a share based on the dividends you receive. And therein is the name, the dividend growth model. So, it is especially relevant for minority shareholders where you do not exert control. You are also not able to manipulate or direct the cash flows of the company because you are a minority shareholder, and all you are entitled to are your dividends. These are the only cash flows you are entitled to. So in this formula, we value a share, as you see here. PO is the price of the share. We value the share based on D0, which is the current dividend or the dividend which you're going to get very shortly. Alright? You would take that, we will call that the current dividend, make it grow, 1 plus G. G refers to the expected annual growth rate in dividends. So, take the current dividend, make it grow, and divide it by KE minus G. KE being the cost of equity. Now, this is one way to write the formula. It could be rewritten into this. D01 plus G being the current dividend growing. Wouldn't it just be D1? Oops, excuse that. I want to use a highlighter actually. D1, the next dividend, 1 period later. Current dividend, make it grow once. Wouldn't it just be the next dividend? So it could be written in two ways. The first way or the second way, both are equivalent. Now, it is worthwhile to note that there are two conditions before you use this formula. The first condition is there must be constant growth. The G, you must have a constant G. If the growth is changing, at one moment it's 3%, at another period it will be 5%, this formula does not apply. Alright? So there must be constant growth, and the second one is an important criteria too. It must be a time horizon that stretches to not 10 years later, not 20 years later. It must be a time horizon that stretches to infinity. Alright? So, with these two conditions, when they are met, we can start with executing this formula. So let's look at an example here. So we have this, Junzio Limited has just issued a dividend of 60 cents. Just issued. Now, wouldn't this fall under D0? The dividend that is just paid? So, Junzio has just issued 60 cents. It is expected to increase the dividend at an annual rate of 2%. That sounds constant. This is my G. Shareholders required return 12%. This is my cost of equity, my KE. Alright? What would be the value of Junzio's share? we can now solve this. So D0 is 60 cents. You just put in the G, which is 2%, right? We found it earlier. And KE is 12%. Minus G, here you got it. Give me a second to hammer it out on my calculator. And you will get for yourself the share being worth $6.12. So this is the simplest execution of the dividend growth model. In the SCA BG syllabus, we will not really be using this. You could jolly well find an exam paper that does not even ask you to use dividends to calculate the value of the share. But almost every exam paper will cover terminal value. Okay? So as I said, in our SCA BG module, the dividend growth model is more often used for calculating the terminal value of a firm's cash flow. Now, what does the terminal value mean? We will see in an upcoming example. But let's just see how this model is adapted to cash flows. So it will be the same thing like you see here. Exactly the same variables, except instead of D0 being the dividend just paid or the current dividend, D0 here will be the current cash flow. G will be the expected annual growth rate in cash flows. So instead of dividends, we now replace it with a more general word. We replace it with cash flows. And it makes sense. Anyway, dividend is a cash flow, isn't it? So these two words actually can be substituted, right? But because we're going to see the later question, we are going to deal with free cash flows. Now we'll call all the D's and the G's. We will use the word cash flows. Even the PO here, it was the price of the share earlier, but now it is the present value of your stream of cash flows. Okay, now let's see how this all works. Let's go to an example pronto. Let's go now. So here we have a set of cash flows. Do not be overwhelmed by the numbers. They are placed in there to give you a realistic sense of how the question is. And they're quite simple. You have your sales. There will be a contribution of 30% on the sales. So this is your contribution. You minus off your fixed costs. Alright? And you have operating cash flows. Factor in your tax, working capital, and capex. You are now deriving the final cash flows for each period. But notice though, each cash flow corresponds to a period. 20Y0, this is the cash flow, 31. 20Y1, 41. Y2, 54.4, so on and so forth. When we value a company though, we can't just assume that this company will last for 5 years. What happens after that? It can't be going bankrupt after 5 years, right? We can't assume it that way. Usually, we assume that the company will last forever. Of course, it is not realistic, but it is a better assumption than deciding when the company dies. Right? Will the company die on year 5, year 9, year 14, year 28? We have no idea. And that is a shaky and bad assumption actually. Right? In practice, what we have assumed then is the going concern assumption. We assume that your cash flows, even after 20Y4, you continue on and you stretch to infinity. You last forever. You are a going concern. In that case, how do I value all the cash flows from Y4 to infinity? That is terminal value. So, if I have to write out a quick definition of terminal value, in here, in this question, it would be the value of my cash flows from after 20y4 to infinity. So what would be those values? Now, I scroll to the bottom for just a second to highlight. The question will usually mention to you that after 20y4, cash flows grow at 3% per year. This is constant. It's going to stretch until infinity. Your two conditions are met. Therefore, we can bring in the formula. So what is the formula? Again, we would call it as P equals to, this time we can put it as D0 1 plus G over KE minus G. Alright, so I am looking at from 20y4 to infinity. Now 20y4, we just had 69.6 as the cash flow. So I will put this as 69.6. It will grow at 3%. And my cost of capital, or your KE for this question, is 12%. You minus the growth. So here, let's work it out. 69.6 times 1.03 works out to 71.688. And I divide by 0.09. So what I have will be 796.53. Now, guys, this is the value of your cash flows from after 20y4 to infinity. Now, constantly saying after 20y4 to infinity is quite a mouthful. How about let's rewrite this? Okay, so excuse that box. Alright, I'll do it again. You'll not appear. Okay, why not we say, isn't it the same thing? From 20y5 to infinity. Because after 20y4 is 20y5, right? So why not we call it that? It is easier to comprehend as well. So my cash flows from 20y5 to infinity is valued now at 796.53. Now, there is one thing about this formula that you need to know. Okay? This 796.53 is not the value as at year 0, or it is not the value as at now. Your formula is not that smart, honestly. Alright? It's just a simple formula. It's mechanical. It doesn't know what goes in. It just gives you an answer. This formula is created in a way that it would always just bring you one period back. This is the discounting it does. It takes your cash flow and it brings you one period back. The question you have to ask then is, what is the cash flow that we are looking at? What period is the cash flow that we are looking at? Now, we look above. Didn't we earlier say, I am staring at my cash flows from 20y5 to infinity? And it does make sense, isn't it? You look, isn't this cash flow here 20y5? Okay? So this cash flow is 20y5. I always advise students, ask yourself the cash flow that I'm putting in the formula and working out the answer. Which year are we working out the cash flow for? It is 20y5. Now be very careful. To reach 20y5, of course you needed to put 20y4's cash flow here. Some of you, as you're watching the video, you might be thinking, isn't it 20y4? 69.6 here? Yes, but we went to grow it by 3%, didn't we? Because we are aiming for the 20y5 cash flow. So we're going to take 20y5 cash flow, bring us one period back, which means this when brought back one period, is not year 0. This is 20Y5 brought back one period. It would be the value as at 20Y4. Which means, people, let's use the table now. Alright? Which means, people, my terminal value, yes, I'm going to fill it up here. Alright? I'm going to fill it up here. So, in here, my terminal value, I will put it as 796.53. But I remember it is as per 20Y4. In that case, I will then multiply by the discount factor. Okay? So what is the discount factor for 20Y4? You notice here, 20Y4 is at 0.5674. So any cash flow that is at 20Y4, if I want to bring it back to now, year 0, okay, I will just multiply by this discount factor. If you want the working for this discount factor, now, these people is year 1, this is year 2, this is year 3, this is year 4, this is year 5. Okay? So we must be getting used to slight complications like this, whereby 20Y4, much as we like to think it is year 4, it is not. It is year 5 of your cash flow. So this was calculated by 1 plus 12% power minus 5. From year 5, bring it back to now. You can try it out. 1.12 power minus 5. You will get 0.5674. So you take this number, 0.5674 times your terminal value, and you would find the present value of it. So 796.53. I will get myself the present value of 451.95. To find the net present value of my project or my company, add up all the present values. 27.68 plus 32.68, I'm referring to the numbers here, plus 38.72 plus 37.88 plus 39.49 plus 451.95. And my net present value is 628.4. Okay? So this is how we value all the cash flows. So I valued my cash flow. For the first year, I went to get $31. I discounted it. This is the present value. Same thing for year 2. I discounted it. This is the present value. Same for year 3, year 4, year 5. But after year 5, all the cash flows to infinity. How do I value it? I use the dividend growth formula. Now, there is one unique thing about the dividend growth formula. It does not bring you immediately to present value. All it does is it brings you one period back. This formula is blind, right? This formula is blind. It is unconscious, unfeeling, unknowing. All it does, put your numbers in. I will give you the value one period behind. So if my final cash flow was for 20Y5, I put it in. It will just give me a cash flow value as at 20Y4. So I would have to put it as Y4, discount it further, get the present value as at year 0. As a reminder, I would then put here, this is the value as at now, the present value, year 0, and then we can add up our NPV. Okay? Now, let's take this again with another example. So feel free to pause the video anywhere you wish to digest. It is the benefit of going on YouTube or making a video. You can pause, digest, work it out yourself with your calculator, and then proceed to this practice question. So here we have yet another scenario. A company This time Y4, Y5, Y6, Y7, cash flows, and right at the bottom they mention assume that after 20Y7 your cash flows grow at 4%, cost of capital is 14%. So I have my present value for the individual cash flows, right? So this would be year 1, this would be year 2, this would be year 3, this would be year 4. So I've gotten all of them. You take their respective cash flows, discount them, respective cash flows, discount them, so on and so forth. If you are really new to time value of money and you're not sure how these numbers are derived, people, it's just like this, 1.14 power minus 1. This is called the discount factor, times 1.14 power minus 2. So this is what I have to multiply by in order to get my present value here. So we wish to embrace our terminal value. How do we calculate that? Same thing, all right? I would do the workings above here. I'll just P equal D0 1 plus G over KE minus G. Now, when I'm looking at terminal value, the latest cash flow will be 105.52. And I'm told it grows by 4%. So, place it in. KE, 14%. Alright, let me scroll down. I know my face might be blocking the 14%. You can see cost of capital is 14%. So, let's use that. Let's fill it in. What I have now will be 105.52 times 1.04 divided by 10%. So I get a huge number, 10,974. Oops, a mistake in calculation, people. Yeah, 1 decimal point too far. It should just be 10,974.4. Yeah, let me just double check this, okay? Because I'm doing my workings live so that you also can follow me. Okay, yeah, perfect. Maybe I'll just round it as 0.41 here. So I have my cash flow 1097.41 as the terminal value. The key we need to remind ourselves though, when is this? When is this? To solve that, I need to ask which cash flow am I looking at? When I'm taking 105.52, which is at year 4, 105.52, and I'm growing it, what cash flow am I looking at? What cash flow am I putting as the numerator? Okay, if I squeeze it here, isn't it 105.52 times a growth of 4%? Isn't it 109.74 divided by 0.1? People, this cash flow here, it is in year 5. Alright? Because the earlier one, 105.52, was year 4, you are growing it by one period. So now you are saying, I'm putting a cash flow that is year 5, I'm putting it into the formula, and the formula tells me it is worth 1097.41. Remember, the formula only brings you one period back. So I'll type it out. So since the cash flow is at year 5, the formula gives me an answer for one period back, and this would be year 4. So people, in here, my year 4 would then say that my terminal value 1097.41 is similar to whatever you got in year 4, 105.52. You use this discount factor, so you're just going to use this discount factor as well. So 1097.41 times 0.5921, you get 649.78. Okay? If you want to work it out manually, it's 1.14 power minus 4. This gives you the discount factor here. So now we have brought it to year 0. It is valued as at now. Let's add it all up. We would then have our net present value. So I'll add it up in a rounded way. There might be some rounding when you yourself add it up. So please pardon that if it occurs. So here, 866.54. This is what you have. Your net present value for the whole project, you have taken into consideration every single cash flow. From year 1, year 2, year 3, year 4. And your terminal value, as we said, my cash flow place was actually year 5 all the way to infinity. And what the formula did? Took it in year 5, brought it 1 period back to year 4. So keep in mind, this is the value of the dividend growth model in the SCAQ BG module. Feel free to look through this video a second time, pause, work it out yourself, match your workings with mine. When you have it, you are ready for the classes, you are ready to tackle the exam questions. Alright? So my name again is Irwin. I will conclude here. If you wish to get in touch, drop me a message on LinkedIn or connect with me on LinkedIn. Or else, there also is my personal email here. Feel free to drop me an email with any questions you have on today's video. So thank you again for joining me, and we'll catch up again on another video. So thank you very much, guys. See you. Bye-bye.